Welcome to PhillipCapital's Weekly Market Watch. Last week, a winning streak of 6-week uptrend had its momentum broken with a sharp correction. Today, we have Ms. Madeline Chong, CFD dealer from Phillip Securities, to share her views. So Madeline, could you give us an update on the market?
Yes, indeed. I think for the past 6 weeks, we had a very strong uptrend, which has been broken by the sharp correction last week. So what we could see here is, I think many investors are left very confused as to the direction of the market in which it's trading at right now. If you look at from the day's trader point of view, I think for the past week, the wild gyrations of the share prices have resulted in a lot of stop losses for them, sudden swings and sudden reversals within a day. So that again has also left them feeling really confused. I think that whenever you are in doubt of the market's direction, it's always good to take a step backwards, re-evaluate what are the options. If you look at the market, after all, it can only go 3 ways: up, down, or sideways. So as long as you know what are the signals to look out for, you should be able to identify the short-term and long-term trends in the market.
Are we in a sustainable rally then?
Well, we are seeing signs that the market may be turning around. In January, when I did the market outlook, I noted that some of the counters have their 20 days moving averages crossing above the 50-day. Now, till today, I think these counters are still rallying. Okay, they're still steadily moving outwards. So right now, we see STI itself, as well as some of our blue chips and broad-based counters, having some moving averages crossing up as well. Now, this signifies, I think, strength for the overall market, and it meant that the market has more of a bullish biasness in the midterm. Now, what we should be careful is, I think STI has formed a double bottom at 1450. Without completing the indicator by going above the resistance at 1960, with strong volume, it means that we may not be in a sustainable rally. So investors with a bullish outlook, I think they'll do well to be cautious and consider taking profits whenever we are near the resistance. We are right now considered as being in the bear rally until we clear the resistance.
Do we see further weakness for the market if we are not in a rally?
I think in the short term, when we look at the hourly charts and look at MACD, now these indicators are showing retracements in the market, at least for the next few weeks. So a very bad retracement would take us at least 2/3 down from our recent high of 1950 to about 1615. A 50% retracement would take us to about 1700, and a 1/3 retracement is about 1785. I think so far, if you look at our market, it's been propped up by the dividends, because it's dividend season. Now, when all these dividends are all paid up, we'll see share prices will begin to be discounted, and STI will be lower than where we are right now. Now, how bad it falls really depends on the kind of news we have in the market. So when we look at the downside, I believe that the minimum that we can go to is 1450. 1450 is the lowest STI can go in this economic crisis, because by changing the way that banks value their assets with this new mark-to-market ruling by the US, it sets a floor to how bad the financial books can be. And this helps to remove some of the worst shocks the market has been experiencing from the financial sector.
How do we know we are moving sideways then?
Well, market is moving sideways when we are stuck in a trading range. This possibility is brewing, but not yet recognizable by many of the financial practitioners. Now, continuous failure to cross a resistance at 1960 could mean that the STI is trading sideways between 1450 and 1960. As time passes, consolidation should begin to form, and with a breakout on the upside or the downside depending. Now, to trade a sideways market, I think traders should use oscillators to help them to make the entry or exit point. We take historical perspective as a guide for us. Now, in 1994 to 1997, our market was stuck in a trading range of 1570 to 2175. Now, these long trading ranges have occurred before, so we cannot dismiss the possibility of it occurring again.
Any other advice for our investors?
Yes, I think the last words is to beware of the hung of Baskervilles. In Alexander's eldest book, right, he actually mentioned about this hung. Now, when a reliable indicator fails to perform and the market moves opposite in the opposite direction, it actually meant that there are fundamental changes in the market. So investors will do well, right, to move in gear with the new trend that's forming.
Thank you, Madeline, for your time today. With that, we come to the end of this week's Market Watch. Join us next week for more market updates.